All right, so here you go. Welcome. We're going to be doing the second practice questions or the second study guide. This is for the midterm, okay? So I will be asking you the first 6 chapters. The format's going to be very similar to the first one, okay? I will be testing you this small section where I will be testing you on determining the account type, the category, and what normal balance it has. So here you can choose from the list here. Okay, so what are the what are the account types, right? There's only 5 of them. What are the categories right here, and whether it has a normal balance, debit or credit, okay? So here are like 15 examples of what you could be tested on. So once again, let's go ahead and go through this. The same format's going to be for the exam. I'm going to give you an account, okay? No description, because by now you guys should kind of understand what each account is, okay? Like you guys know what a checking account is, okay? So I'll give you the account name. You need to determine the account type, category, and whether it's a debit or credit balance or normal balance. And of course, I'll give you multiple choice. So you'll have A, asset, current, and debit, okay? B, assets, other, credit. You'll have a list of that options that you could choose from. Okay. So let's go ahead and go through this list here, and let's practice. So first one, we have checking. What kind of account is checking?
Can I look at the options?
Yeah.
So it would be asset.
It is an asset, right? You own the money that's in your bank. Okay. Now, what kind of asset would it be?
Current.
It'd be current, right? Because it's in its most readily available form, which is cash. It's liquid. It's already there. And what kind of normal balance would typically increase this account? So this is where the accounting model is coming into play.
Credit.
Not credit. So here, let's take a look at the accounting model. Okay. So the normal balance is the positive side, which each account increases on. Okay, so in this case, assets. What increases assets?
Debit.
Debits. Good. Okay. What about accounts payable?
Liability.
It's a liability, right? It's where you owe people on money. Okay. What kind of liability would this be?
Current.
Current, right? Because you would normally owe somebody usually within a year, right? 30, 60, 90 days, or even within 1 year. Okay. And what kind of balance would normally increase a liability?
Credit.
Good, right? Credits do increase liabilities. Okay. What about inventory?
Asset.
Yes, you own it, right? You own the inventory items before you sell it. Now, what kind of asset would it be?
Current.
Current, because all you have to do is just sell it and you get instant cash out of it. Okay? And what kind of normal balance would this have?
Debit.
it would have a debit balance. All right, next one. Supplies expense.
Expenses.
Mm-hmm. Mm-hmm. Your dead giveaway or your hint here is it has the word expense. Good. Now, what kind of expense would this be?
Operating
It be an operating expense. Excellent. Right? You need to have some supplies to be used during the accounting period to operate your business. Right? Now, what kind of balance would this have? What would increase expenses?
debit.
Debit, right? So again, if you remember, assets and expenses flow in the same direction. Your liabilities, equity, and revenues flow in the same direction. So if you remember that much, okay, that will help you out tremendously. So inventory. Bless you.
Thank you.
Okay. What about let me see. What about accumulated depreciation?
Asset.
Yes, it is an asset. What kind of asset?
Fixed.
Yes, it is, right? Accumulated depreciation. What kind of account is accumulated depreciation? What direction would it fall under? Would it flow?
Debit.
Not debit. Okay, what is accumulated depreciation?
It's a fixed asset.
It's part of a fixed asset. What does it do?
It calculates the new value of every year.
Okay. And what is it doing to the asset itself?
It's losing value.
It's losing value. So would you increase it or would you decrease it?
Decrease.
You would decrease it. So in this case, this gives a credit, right? So a big indicator about this is we have to understand that this is a contra account, right? Accumulated depreciation is a contra account to a fixed asset. Good. So if it's a contra, it would normally flow in the opposite direction. Good. What about bad debt expense?
Liability.
Not necessarily a liability. Remember, bad debt is when customers owe you money.
Asset.
No.
What are my options? I forgot. Can okay. Expenses.
Yeah, because again, you have that keyword expenses, but this is when, right? So when you decide at the end of the accounting period, right? You decide to write off your bad debt, meaning you're going to get rid of it off your books because you can't collect that money anymore. That's called bad debt expense. Okay? Okay. So if you have bad debt expense, okay, what kind of expense would this fall under?
Operating.
Good, right? It's the part of operating your business is you'll end up having to write off bad debt, right? And what normal balance would this normally have?
Debit.
Mm-hmm. You would definitely increase your bad debt expense with a credit. I mean, with the debit. Okay. Oh, I have another inventory in here, so we could skip over that one. What about unearned revenue?
Asset.
It's not an asset. It's unearned revenue.
Income.
You haven't earned it yet. Okay, so do you remember? So you remember this, okay? Unearned revenue is when customers give you money in advance for services that you haven't done yet. They give you an advance payment.
Liability.
Yes, because you owe them service. Now, what kind of liability would this tip be?
Operate.
Not operating.
Can we scroll? Sales.
This is liabilities. So let's take a look at the review sheet one more time. For liabilities, what kind of categories fall under liabilities?
Current or long term.
So what would this be?
Current.
It'd be current because you're gonna definitely owe services within a year. No one in their right mind would buy something in advance a year and expect you to complete the service a year later. So for sure, this is 100% going to be current. Now, how do you increase a liability?
Credit.
Good. Okay. What about accounts receivable?
Income.
No. You haven't earned the dollar yet.
Asset.
Yes, right? Because it's money that your customers owe you, right? So you can claim that money almost instantly, right?
Still current.
It'd be current, yeah. And what kind of balance would this have?
Debit.
Good. Okay. What about furniture?
Asset.
It's an asset, okay. What kind of asset?
Fixed.
Good. And what kind of balance would this have?
Debit.
Okay, what about owner's withdrawal?
Asset.
No, this is owner's withdrawal. You don't own your withdrawals.
Liability.
You don't owe your withdrawals either.
Expense.
You wouldn't spend your withdrawals either.
Income.
You don't earn your withdrawals either.
Oh my god. Equity.
It would be equity because this is taking money away from the company, right? If you invested money into your company and then you decided to take it away, that's an owner's withdrawal.
Okay.
So equity.
No cash
No category. Excellent. And what kind of balance would this have?
Debit.
Yes, because it flows in the opposite direction, right? Instead of increasing in equity, which we would normally with a credit, right? We're going to decrease the equity by withdrawing money. So we're taking away the money. So in this case, that is correct. It is a debit. Okay. How about sales?
Income.
That's, yes, sales is going to be how we generate income. Okay. Now, what kind of income?
Sales.
Sales or operating, whichever one is available. Okay. And what kind of balance would this have? How do you increase sales?
Debit.
Okay, let's take a look again. How do you increase your sales?
Credit.
You would use a credit, right? So think of every time we journalize, right? We journalize our sales, right? It's always on the credit side because we increased our sales. And the opposite of that would be receiving money. So it'd be credit. Okay. What about cost of goods sold?
Income.
Not income. It's the cost of goods sold. How much did it cost you to sell? Is that something that you're generating income out of?
No.
No.
It would be expense.
It would definitely be an expense. Right? Now, what kind of expense?
Cogs.
It'd be COGS. Good. Cost of goods sold, right? Because this is going to be directly correlated to your sales and your inventory. Okay. Now, what kind of balance would this have?
Debit.
Yes, all expenses will typically have debits. Okay. Depreciation expense.
Expense.
Now, what kind of expense would that be?
Fixed.
Not fixed. It's part of a fixed asset, but this is an expense, right?
Operating expense.
It'd be an operating expense because look here. There's only 2 categories or 3 categories that we learned in expenses, right? Cost of goods sold, which is directly correlated to the sales and inventory. And then you have operating, right? I didn't teach you non-operating or other. Okay, so in this case, your only option here is operating. Because during the year or during the accounting period, you would choose to lower the value of your fixed assets for that month, for that year. So in this case, this would definitely increase. Now, how do you increase an expense?
Debit.
Good. All right, and last but not least, what about the allowance for doubtful accounts? What is the allowance for doubtful accounts?
Expense.
Not an expense. What is the allowance for doubtful accounts? Like what kind of account is this?
Contra.
It's a contra account to what?
To the revenue.
Not revenue.
Income.
Not income. The income and revenues are the same. You're not generating money out of this.
Liability.
You don't owe money for this.
Where am I going? Asset.
Yes, because what is this directly correlated to? Your accounts receivable. When customers owe you money, right? That's where the allowance or doubtful accounts come, because if one day your customer decides to say, I can't pay you anymore, that means that debt is potentially bad, right? You might not be able to collect it ever again, or you might have to just send massive emails, phone calls, trying to collect the debt until they give in and they say okay. Okay? So in this case, this definitely is an asset. Now, what kind of asset? What kind of asset is accounts receivable?
Sorry, collecting. Accounts receivable. I'm not sure.
Accounts receivable?
Oh, we have that one there.
Yeah.
Okay. So accounts receivable, we would be receiving money.
Mm-hmm.
Okay. So asset current.
It'd be a current asset, correct? Because you can easily turn around and get that money back, right? Even though the customers owe it to you, you just send them a letter, call them up, and then they can transfer the money to you like instantly. Okay? Now the allowance for doubtful accounts, you did mention this. It's a contra account, right? It decreases your accounts receivable. So in this case, what direction would it flow for the normal balance?
Credit.
It would give you a credit balance. Good. Right? Because you're decreasing what people owe you, because it's saying that you might not collect this money that people owe you. Okay, good. All right. So I'll be testing you on a couple of these. Okay. So let's see what the next section is. Next section here is chapter 4. So again, knowing the ins and outs of the accounting cycle and the rules of GAAP. So here, first one, under the rules of GAAP, okay, which rule states that when you establish a business, you need to keep your personal and your business transactions separate.
Business or economic entity.
That's correct. That's correct. Okay. Number 5, okay, if I purchase a machine for $500, okay, in my books, I must record it at $500, even if I plan to sell it for $700, okay? Which GAAP rule states this? A, cost benefit? No, that's when you have two options and you have to weigh the cost amongst its benefits.
B.
B, monetary? Not necessarily, because I didn't say that you have to record it in terms of value. See historical costs, yes. Okay, just because when you purchase something, it must be recorded at historical cost value, meaning fair market value, the day that you purchased it. If it's going to be in your books, you're gonna record it for the price that you paid, which in this case was $500. Even if you plan in the future to sell it off for $700, it must remain $500 in your book until you get rid of it. Okay? Same thing if you try to get rid of it and let's say you expect at least $300 out of it and take a $200 loss, you still need to record it in your books at $500 because it doesn't matter how old your asset is. If you had it for 10 years, it will still remain $500 in your books until you dispose it. Okay? So in this case, this is the historical cost. All right. You need to know how to be able to apply them as well. Okay. So another one here, customer A purchases an item for $15.65 from your store on an account. Okay. A few days later, okay, you receive a check for $15.65. You must properly record the sale and payment. Okay. So which gap rule governs this?
B.
B, matching principles correct, right? Because you sold somebody $15.65 and they send you $15.65, right? You must record the sale and the revenue that you earned, but as well as the cost, right? So you have to match up your numbers. So this is correct. Good. Okay. Cash basis is when A, right? Revenues are recorded when cash is received, right? Where B says expenses are recorded when it has incurred, which in this case, no. Revenues are recorded when sales have been earned, no, right? The purpose of cash basis is basically exactly, right? You need cash to be able to operate your business, right? You need cash to flow in and you need cash to flow out. So in this case, A is correct for cash basis. Sorry about that. Shh.
You're fine. What kind of dog do you have?
It's a Chihuahua. Shh. It's a Chihuahua Terrier mix, so.
Boy or girl?
It's a girl.
Oh.
All right, number 8. Which of the following is not a step in the accounting cycle? Not a step. What was it?
B.
D. Making decisions based on your financial statements. Yes, you never formulate any opinions into your financial statements. Okay? Right? Recording transactions in the general ledger is going to be step 4. Producing the financial statements is step 8. Doing the trial balance is step 5. And then closing the books is step 9. So in this case, making decisions based on your financial statements is none of those steps. Okay? So make sure you do take a look at that. Okay? And like I mentioned before, right, when we're talking about the accounting cycle, make sure you know what the steps are. You don't need to know what the details are because we won't actually dive into the rest of the details until after your exam. So in a week from now. Okay, and another thing too is out of these rules of gap, right? I'm only going to test you on your assumptions and your basic principles. Your constraint and your conventions are more for managerial accounting. So this is not really necessarily something that you would definitely need to memorize for this class. Okay, so in this case, I'm not going to test you on the last 4, but I'll test you on the first 8. Okay. Okay. All right, chapter 5. Okay, what are the tracking methods used for inventory?
A.
Periodic and perpetuals, correct. Right?
So those other 8 you're gonna test us on this exam?
Mm-hmm. You need to know the definitions and how to apply those definitions because I could give you a scenario. So, like, for instance, that one where a customer bought something for $15.65, that is applied knowledge, right? You're applying the concept to the scenario.
Okay.
Okay, so this one, good. Tracking method for inventory, right? This is only strictly for inventory. Okay. Number 10. Okay, what are the costing methods used for inventory? D, all of the above is correct, right? We learned periodic, FIFO, LIFO, and weighted average. We learned perpetual FIFO, LIFO, and moving average. And we also learned specific ID. Actually, no, we did not learn the specific ID, but we did talk about it, right? It's like an auto mechanic shop, right? You keep track of your inventory based on the specifics of that item. Okay. Number 11. Okay, when delivery charges are made on COD, what does that mean?
C.
Cash on delivery. Good. Okay. Number 12. Okay, what is the definition of periodic and perpetual? A, right? Periodic means once in a while. Perpetual means constantly. Okay. Number 13, true or false, at the end of the period, under the periodic tracking method, okay, a conversion entry is needed.
True.
That is true, right? At the end of a periodic inventory, when we finish our inventory worksheet, we must complete the conversion entry, right? From expense into inventory and cost of goods sold. So yes, under periodic inventory. Okay. All right, so now let's go ahead and dive into an example here. So here, use the following information with the table to answer the next 2 questions. So here's your scenario, right? You have June 1st that you purchase 100 toys. Okay, so skipping this whole section here, the most important thing that you want to look for is your tracking and costing method is periodic LIFO. Okay. So in this case, let's go ahead and go through the scenarios. So on June 1st, you purchase 100 toys costing at $1 each with a freight of 25. So in this case, purchase price,
1,000.
just 100 times $1.
Oh, 100.
Okay, plus 25. Total cost 125. Now in this case, this is LIFO. Do we need to separate our batches of inventory?
Yes.
Yes. So in this case, what is my cost per item for this batch?
125.
$1.25. Okay. Next one says that on June 10, you end up purchasing 200 toys for $1.25 each with a freight of 50. Okay, so what's my purchase price here?
250.
Okay, plus 50,
300.
giving you a cost per item of
150.
$1.50. Okay. So then June 12th, you end up selling 200 toys for $5 each. No sales tax was charged. So in this case, what do I do with the sales?
You don't record it.
You don't record it, right? Because it's periodic. We don't keep track of sales. Okay, we only keep track of our purchases, and at the end of the accounting period, we'll figure it out after that. Okay? So good. So then the next one is going to be June 15. Okay, you made another purchase of 300 toys at $1.50 with a freight of 75. Okay, good.
450 and 525. And 175.
Good. Okay. June 20th, we sold, which you said to skip it. So then on June 30th, you should have a total of 150 toys available on hand. Okay. So tally up your totals. What was the total amount that you purchased?
600.
We bought 600. Okay, at a total purchase price of
800.
800. What's my total freight?
150.
150. So what's my total cost?
950.
950. Okay. And we know that we have 150 left on hand. So what is our assumption? How many items did we sell?
450.
450, right? If we have 600 and we only have 150 left, we must have sold 450. Okay. So using LIFO, last in, first out, okay, how would you calculate this? Which batch of inventory would you take out from first?
The last one.
The last one, right? For 300, right? At $1.75 each, which we know gave us a total of $525. We still need to sell how much more?
150.
We still need to sell 150. So which batch of inventory are we going to take out from next?
The 200.
The 200, right? 200 is going to cost me $1.50. Okay? So 200 times $1.50.
you mean one?
Yeah, $1.50.
150 or 200?
Oh, sorry, 150 times $1.50.
225.
225. Okay. So if you tally up those totals, you would get a total of 450 units at a grand total cost of goods sold to be
750.
750. So if this gives you 750, what is your total ending balance?
200.
200, right? So since you sold the second one for 225, right, you should have left $75 plus 125 will give you 200. Good. Okay. So first question here is, what is the total cost of your ending inventory balance on hand? Yeah, 200. And then what is the total cost of your cost of goods sold?
Same.
Okay, good. So here's the same exact thing here, except this time you have periodic FIFO. So in this case, this is going to be the exact same questions or exact same chart here. So I'm just going to copy this over. The only difference is how you calculate the cost, right? So in this case, right, you still have June 1st, you purchased 100. June 10, you purchased 200. June 15, you purchased 300. Okay. And at the end of June 30th, you have a total of 150 units. So in this case, I saved you some time here. Okay. All right, so there you go, 600 units available, and you have 150 that you have left. So therefore, you must have sold 450. But now, using the rules of FIFO, first in, first out, how am I going to calculate the total cost of goods sold? Right? Which batch of inventory am I going to sell out first?
100.
Your first 100 at $1.25. So that should give you 125. Okay? How many more do you need to keep selling?
350.
We need to sell 350. So which batch of inventory are you going to take out from next?
200.
You're going to take out the 200 at 150, which in this case, you're taking all of it. It's going to give you $300. Okay? So now I only have one batch of inventory left, and how much do I need to sell from there?
150.
You need to sell 150 at $1.75, which will give you a total of
150. 262.50.
$262.50. So in this case, you have a grand total of 450 units at a grand total cost of
3, 4, 5, 600. 670, 87.
8750. Good. So that's your answer here. Okay, so then what is going to be your ending balance in your inventory on hand? There's two ways you could solve for this, right? You can either subtract it out of the 950, or you can simply just take, well, you have 150 left at $1.75.
262.50.
262.50. Good. All right. So once again, 262.50 is your ending balance, and the cost of goods sold here is the 687.50. Good. Right. Another exact same one, except the only difference here, this is weighted average, okay? So I'm going to copy and paste it all again here. But the difference here is what? What's the difference here for weighted average?
Doesn't matter.
Yes, the order doesn't matter. But what else do I need to solve for?
The cost per item.
The cost per item. Instead of doing a cost per item per batch, I need to find out what the average cost of all my total cost with all my total quantity of units. So in this case, what should be my grand total? So what is my average cost per item going to be? Okay, first off, what's my total cost?
$9.50.
Okay. And you're going to divide that by your total quantity.
600.
Mm-hmm. So what is your average cost per item?
158.
Keep going.
333.
Okay. 158,333. Okay. So if I have 150 remaining, that means I should have sold 450. So this is where it's easy because all I have to do is figure out what 450 times $1.58.333 is, and what do you get?
$712.50.
712.50. Good. So then what should be my ending balance?
$237.50.
237.50, right? You could take that from your 950 and get the same answer, or you could have just taken 150 times $1.583333 and get the same answer. Okay. So, question says here, what is the total cost of your ending balance in your inventory? Good. And then what is the total cost of your cost of goods sold? 712.50. Okay. So that's practicing the inventory methods. And here you go. Let's practice the conversion entry. So how do I convert this scenario right here into a conversion entry? So let's say it's June 30th, right? So how do I do my conversion entry? I have an ending balance of 237.50, cost of goods sold of 712.50, 600 units available. How do I do my conversion entry?
Inventory.
You're going to recognize inventory first. Good. Okay? For how much?
237.50.
Right? That was your ending balance in inventory for 237.50. What about the next one? What else am I going to recognize?
Cost of goods sold.
You're going to recognize that you sold some units along the way. For how much?
7, 12, 50.
Good. All right. What else do I need to recognize? I'm doing a conversion entry. What am I converting from?
From inventory to sales.
Not no. When I bought my inventory, what did I recognize them as if this is periodic inventory?
When you what?
When I purchased them, my inventory items, what did I recognize them as under periodic inventory?
Inventory?
No. If we did, there would be no purpose of having to do a conversion entry. So if I have periodic inventory, right, and I purchase something, what would I recognize those items as?
Purchase expense.
Purchase expense. Good, right? And that's why I need to convert them, because they go from expense to inventory. So in this case, purchase expense. And what else?
Freight.
Okay. So in this case, what is my total purchase expense?
950.
That's your total cost. That includes freight.
800.
800. Good. And my freight is
150.
good. Okay. So that's the conversion entry right there. Okay. Good. Okay, on June 17, if you received 10 broken mugs, okay, and you requested for a full refund from the vendor, okay, what accounts will be journalized for the return if you are using periodic inventory?
It would be B.
D, no. Okay, this is the key word here is periodic inventory. So we just talked about this, right? What did you recognize your purchases of inventory as in the very beginning?
Inventory.
No. Under periodic inventory, we recognize them as a purchase expense, right? So because we recognize it as a purchase expense, here's the thing about expenses. You can't really undo them, right? You spend money for the company, that's it. You can't take it back. So it's similar to rent expense, right? If you pay for rent, you can't take it back. So that's the same idea here. So if you can't take it back, then how would you represent that you need to make a return? You need to create a contra account, correct?
Yeah.
So in this case,
So it would be A.
purchase returns and allowance. Debit, not debit. Actually, wait, hold on. Debit. Yeah, not debit, right? Because if a purchase expense is already debited, why would you increase it if you're trying to decrease the inventory items?
So D.
Not D, not inventory. It's never inventory.
I said B.
Oh, you said B as in boy?
Yeah.
Oh, okay. I heard A and D. Okay.
No,
Yes.
my first choice was B.
Okay, so yes, B, purchase returns and allowances, and you would credit it. Okay, good. Right, because it's a contra account. You're using this account to decrease your purchase expense.
I was just thinking, I'm like, I'm so confused.
No worries. Sorry, I heard D, inventory. All right, so 22. Okay, if terms are 5%, 15, net 30, what does that mean?
A.
Take a 5% discount if you pay within 15 days. If not, pay in full within 30 is correct. Okay. Number 23. Okay, what does net method mean?
B.
B, you're going to take the discount immediately. So think of it like paychecks, right? You have your gross pay and your net pay. What is your net pay? It's when they take all the taxes out, right? Where your gross pay is before all the taxes are taken out. So that's the same idea here, right? Gross method is you don't take the discount now, you take it later. Net method, you take the discount out immediately, right? All right, chapter 6. So we're finishing up this part here. So a customer buys 10 shirts for $5 each. Sales tax is 8.25%. Total cash sales was for $54.12. The next day, the customer wants to return 5 shirts because they were the wrong size. Okay. The customer demands a full refund for the 5 shirts. What should be the journal entry? What should the journal entry look like? Okay, assume that they are using periodic inventory.
Okay, so they returned 5
Mm-hmm.
shirts when they cost $5 each, and then so would be oh yeah, we have it on. Okay. So they paid. How did they pay?
They paid with
Cash.
cash. Mm-hmm.
So D.
Okay, not D, because what are you forgetting in D?
Oh, C.
Yes, you're forgetting the sales tax, right? If you charge sales tax, you have to give the money back. You cannot just only give the sales back. And the sales returns and allowances, right? Sales tax is not money that you earn. That's money you collect for the government, right? So in this case, it can never be included into the sales. So there you go. Perfect. C is correct. Right? Number 25. Okay, when there is a store-wide sale discount for 40% off, you can only take a discount on what item?
A.
A, merchandise selling price only, right? You can't discount sales tax. No, no, no. You can't cheat the government. You can't discount shipping or handling, right? We talked about this. You can't go to FedEx and say, hey, give me a discount. They're going to laugh at you because it's like, that's not how the system works, right? It's based on weight. It's based on the size of the box and what's actually in it, okay? And then D says none of the above, which isn't true, right? You can discount merchandising selling price. Okay. All right, so go ahead and use the following table to answer the question. So here's a lower cost of market example. Okay, so if you originally bought something for $4.75, they tell you that it's now worth $4.05. You sell it at $10.50. The cost of to dispose it is $1.33, and you want to earn at least $3.55 profit. So in this case, how do I determine the ceiling,
The original cost.
for the ceiling?
The replacement cost.
Not replacement. Selling.
Minus original.
Not original.
Replacement. Yeah, I don't remember. So selling price minus cost of disposal.
Okay, so minus so disposal. So in this case, what's my selling price?
Selling price is $10.50.
Minus disposal.
$1.33.
So what should your total be here?
$9.17.
Right? How do you solve for floor?
Is it replacement?
Not replacement.
Ceiling price and amount of profit.
Okay, so ceiling minus profit. So in this case, what was my ceiling price?
$9.17.
Minus profit of $3.55. So what should you get here?
$5.62.
Okay. Okay. So this is now, I need to determine what the market is. So market is a comparison between three numbers. Okay. So this is where,
So it would be $5.62.
yes, okay, because you're going to compare your three numbers to see where they go in the middle, right? So market is you're comparing. Okay, so we're going to put it in numerical value order. So your ceiling is 917, your floor is 562, and your replacement is 405. So which one's in the middle? You said 562, which is correct. 562. So now the last question asks, which one's lower? Your original cost of 475 or your market price at 562?
$4.75.
475 is definitely lower. Okay? Any questions in regards to the first 6 chapters?
No.
Okay? So once again, please for the review, I let you guys have the review sheets. So this is definitely going to be something useful. It answers about 70% of your exam. So this will help you out a lot, especially when, it's a lot of information. You don't necessarily, you don't necessarily need to memorize this information, but use the resources to help you answer the questions, right? That's the purpose of what I'm testing you on is, can you research your answers? Okay. All right, so tomorrow what we're going to do is we're going to finish off the rest of this study guide.